Go. So we're here with Seth Teagle out of Ohio. He is a multifamily investor and syndicator. I also have my co-host here, Frank Spalding. We're gonna have a great conversation here. Stuff I want to know, we're gonna get questions for. So I'm excited about this one. So Seth, can you tell us about what you've done in the past? I always ask this because I like kind of laying the groundwork, because when you talk multifamily, people are like, oh, you're in the clouds. Like, let's kind of bring it down to reality. So how did you get, like, what did you do in the past? Were you like a construction worker? Where did you start at it?
Yeah, so my story is pretty interesting because I'm like I'm like, in reality, I'm an undercover blue collar guy, right? That I've actually been a fireman for 21 years. I'm still actively serving in that role. I'm probably, I don't know how much longer I'll do it for, but my main partner in the stream group and I are both firemen. That's how we met. That's how we kind of got started together. And we kind of, when we met, we were like, man, we should team up together. But prior to that, I was, I grew up in North Dakota and lived there for most of my life. And then I moved to Florida in 2000 and was there for about 8 years, met my wife, got in the fire service there. And then her dad lived in Columbus, Ohio. And I was kind of like, after working 2 or 3 hurricanes, I was like, man, this is crazy. Hurricane Katrina, Hurricane Ivan, like just watching all this death and destruction. I was like, I don't really know that I think I want to be a visitor, not like a permanent resident down here. So we opted to leave in 2008, and right when the market was crashing and all the craziness was happening, and moved to Ohio. And that was it. I was like I said, fireman for all that time and still am. Probably about 7 years ago, I realized that, I was working tons and tons of hours, and to the point where I just couldn't work anymore and make any more money. And I thought, well, what else can I do? Where there has to be something better for me than just working my regular shift and overtime or having like 2 or 3 jobs. And so, I got into real estate through a friend of mine who I knew in college, and he had like blown up and become this huge investor, hard money lender, has a pretty big following. And, he kind of got the fire lit underneath me to get into real estate. And through some different things that happened along the way, I got into multifamily and been going hard at it ever since.
That is amazing. Firefighter, congratulations. Appreciate your service.
Thank you.
Definitely.
That is amazing. That is amazing. You're the first firefighter we ever interviewed. That's awesome.
Yeah.
Awesome. So tell me, and then here's the other people. I like bringing it down, because people like, how do you get into multifamily? Like, did you start doing wholesale? Did you start doing houses? Like, how did you transition?
I was just about to ask that. What was the first deal?
Yeah. So my first deal was a 50 unit, which sounds crazy, right? That like, what are you, you did what now? This is what I usually get, like, from people. And so for me, like, I realized that real estate could lead to generational wealth or passive income, or, all these things that we hear about. And I was like, that sounds great. Like, my why is always my family. I've got 3 kids. I'm married. The divorce rate for America is like 50%, but it's even worse for people that are like firemen, cops, military, people in the healthcare industry and hospitals all the time. It's just, those jobs are very hard on relationships. And so I was, it's always been a super important thing for me to have a great family life and have a great family life for my kids. And so, when I realized when we start having kids, I'm like, man, with inflation going up, like the money I made last year is not enough this year, and like all these different things. I'm like, what do I do? And so, like I told you, I said I reconnected with that guy, which he kind of got me started, really kind of looking into real estate. And then I spent a couple of years like reading and researching and kind of just getting my feet wet in like, what does this really look like? Because one thing that he told me in the very beginning was, if you're going to get into it, like, your first deal's got to be a home run, or it's got to be good. You just can't have it go bad, because if it goes bad, you're pretty much done. And so I really took it to heart. And so I wanted to kind of like really kind of just sharpen my tools and be ready to go into whatever it looked like. And then I met a guy here locally that was a house flipper. And I was like, man, like, this is the first person I've ever met in real life that's doing this. Like, let me talk to you. Like, let me take you to lunch. Let me buy you a drink or whatever. And when I went and talked with him, what I heard was that he was struggling with finding good project managers for his flips, and he was not finding very good property managers. And so I was like, look, I'll work for free. Like, I don't care. I just want to get my on-the-job training. I want to learn. Like, I got a ton of questions. Like, but I knew with my background in the fire service, I knew construction. I knew how to manage contractors and kind of like run teams. And so I knew that I could do that. I just needed somebody to give me a chance. And so for a year, I worked for him basically for free, doing those things and kind of getting my feet wet. And what I learned or realized kind of in that year was, at the time, I thought I'll be a fireman forever. I'll have some rentals. This will be great. But I realized, like, running all over town and going to these different houses and watching the flips happen, and every house needed some different flooring and different finishes and different vanities and all, it was very logistically, it was just tough. It just required a ton of time, a ton of manpower to try to do these things. And for me, trying to maintain a career, I was like, I need to find the thing, what's the most efficient thing that I can get into. And all I had heard was, over the years, was multifamily. Like 10 units under one roof in one location was much more efficient than having 10 houses spread out over a whole city. And I mean, that I bought into that because I'm like, look, that's, at the time, that's my goal, right? Is to just get in, just have enough to kind of make up the difference or the shortfalls. And then, like I said, I had the opportunity to, basically what I decided, I was like, look, I want to take the knowledge I have, the money that I've saved, and I want to go find the biggest thing that I can buy. And I went to another investor and I said, hey, let's pull the equity out of the houses that you have. Let's pool our resources and let's go find this thing. And we went out to a smaller market outside of Columbus, and we found a 50 unit that was a true value add property. It was probably more value add than I should have bit off of my first deal. But, like I said, I was ready for it. And my schedule at the firehouse is 24 hours on, and we have 2 days off. So I had a lot of time to give towards kind of running the property. And that's what I ended up doing. So, we bought it, and that was the first deal.
That is amazing. First deal.
So at that point, you were self-managing also, correct?
So I bought it and I thought, look, I can do two things. And I knew I was good at construction management. I didn't know how good I was going to be at leasing and managing something of that size. I had done leasing and managing on a smaller scale. The guy that I was managing, he probably had like 15 units. And so I thought, well, I can't do both good. I can do one of them good. What I did was I brought in a third-party manager down there. I went down there and met with several and basically presented my business plan. And I'm like, look, here's what I want to do. And I went with the one that I felt was most aligned with my interests. And I was there every day. I was at the firehouse managing that rental as far as the construction goes and doing the renovations. But it also gave me like the on-site presence to know whether or not they were actually managing my property well. And then if we were having, troubled tenants or there's problems, like I was there to report them and really kind of like light the fire underneath them to make sure they were doing their job. And I think that, had I not been there, it could have been a different story, but because I was there putting the time in, it worked out.
Outstanding.
So tell me,
you look like you had a question, Daniel.
No. I was waiting for you to ask a question. So 50 units. So I know what I noticed a lot about multifamily is that people do different jobs when it comes to multifamily because there's so many different things that need to come together for the deal. Yeah. What part are you in most of these transactions?
So I would say like the biggest role that I have right now and like in our company is finding the deals. So I do a lot of networking, a lot of broker relations. I probably specialize in kind of like being the face of the company. And then I do a lot of back of the napkin kind of like, hey, like they'll send me the deal and I'm like, yep, we like the area. Yep, it fits the box of stuff that we're looking for. Yep, the financials look good. That rent roll looks like those rents look low. I know the market, or I'll do the market research and be like, yeah, I think that, the rents should be this is what they're showing, and I kind of establish like this looks like it fits in our criteria. Then I send it to Tim Shaw, who's my main partner at the Stream Group, and he kind of does like the deep dive, right? Because he will do more of the deep underwriting and really kind of get granular with things. And then we'll circle back to each other and say, here's what he found, here's what I'm thinking, and so we each kind of have our roles because he's like one of the smartest guys I've ever met, which is why when I met him, I'm like, let's team up, right? Because he plugged a lot of the holes that I had and I plug a lot of the holes that he has. So it really worked out well for us. And I'm not the guy, it's very hard for me to sit down and sit in front of a spreadsheet for like 3 or 4 hours, crunch numbers. Like it's like torture to me. But he can't get on and talk to you guys, right? He's like super shy and introverted and wants nothing to do with it. He likes kind of being the guy in the background. He always likes to say that I catch him and then he cleans them, so that's kind of the running joke with the two of us. But that's probably my biggest role. And then I do a lot of the day-to-day operations. I manage the manager that we have, like we're vertically integrated now. So I think that, that's probably a big role that I have is, again, I still have my hand in the construction. We do everything in-house now. So it's like, are they staying on task? Like I'll walk units and I'll kind of like, we'll take, like we buy a place, we're like, okay, this first unit's like a test unit. And I'll go there and I'll say, we want to do this with the flooring, this with the walls, this, I kind of set up the scope of work. And then I
Yep.
monitor them as they kind of do the first one. And then once we know that everybody understands the standard and what our expectations are, then we pass it off to our construction manager, property manager team. And then they kind of go from there. And then I just do like, I check in with them on a regular basis, or I'll go do, I'll show up and walk units, or I'll go up there and, hey, we'll look at the rent roll and we're like, hey, this has been taking a little bit longer than we thought. Like what? So that's a lot of the stuff that I do, like kind of like behind the scenes.
Okay. So now the first one, did you all finance that yourselves, or did you jump straight into trying to find investors to help fund that? And then what was the jump to, becoming an asset manager?
Yeah, so it was the first 50 unit was just me and one other guy. We threw our own money in. We had enough to buy the property and about 50,000 left over, and that was it. And I thought that was enough, right? So you don't know what you don't know getting into your first deal, which is why I always tell people, like, now that was kind of before, like, I didn't really even know about podcasts. I didn't know that, there wasn't a ton of Facebook groups. There wasn't like, there was probably stuff on YouTube, but I just didn't know. I wasn't in the room with all the multifamily people. It was still kind of like I was picking up bits and pieces from Bigger Pockets and other, anything that I could find. And so, I didn't realize, like I had never heard of economic vacancy, right? Where we pull the leases and the leases are saying this and they're saying this on the rent roll, looks great. And then when we actually took over, I realized that they were making like half of what they were actually saying they were. And then we had, what did they have? Like 4 units, I think, were vacant when we bought it. And within the first payout, the first month, we had 12 more people leave just in the middle of the night. I had never heard of that. I had no idea that that was even something that could happen, And so I called a guy in Cleveland who was also a firefighter at one time that had left because he got so big in multifamily. And I was like, what do I do? And he's like, man, you're like way undercapitalized. He's like, the first thing you need to do is go out and raise some money. So I was able to, through friends and family, was able to raise about $250,000. And that is what we ended up using to basically renovate the complex. And again, I did a lot of sweat equity, in my career previous to multifamily. I knew how to do drywall. I knew how to do windows. I knew how to do all this work. So, it was a successful deal because of my background. I would highly suggest other people not doing that. I would say, get a mentor or get hitched to somebody that's already doing it and let them help guide you through the minefield that could be your first deal, right? Because like I said, on a single family flip and you do it wrong, you might lose $10,000-$20,000. On a big multifamily property, if you buy it and then you don't know what you're doing and it starts to nosedive, they're very hard to like pull out from that spiral. And now you're talking hundreds of thousands of dollars or millions of dollars, and in most cases it's other people's money that you're tying up as well. So it becomes a lot bigger of a responsibility.
That's amazing, man. Go ahead, Frank.
Definitely. Well, you touched on one of the things I was going to ask, mentorship. Did you, go out and trial by fire, learn how to raise funds after that first 50 unit, or did you go out and find a mentor who had that experience already? And that's kind of a big jump to go from
so it's
a 50 unit
story,
to 47 million.
Yeah, so we went. So the first deal I did, like I said, it was just 2 of us, and the second deal was kind of the same thing. We refied that first deal in I think around 14 months, and we pulled out $1 million in equity. So it went very, very well, which I was hooked. I'm like, this is it. And like, how awesome is this? Like, that's more money than I'm going to make in like 10 years, in one deal. Like, this is awesome. And so we paid everybody back that we had borrowed money from, and we had about $500,000 left over. And we're like, let's do it again. So we went and bought a 40 unit from the same seller nearby. And we were like, let's just do it. Well, through that one, again, that one was much easier because now I knew what bridge debt was. I knew how to like structure it better and finance it better and get a loan that has the construction piece added into it, where my first one didn't. It was just a straight like traditional like local bank financing. And so that one went good. But what I realized was like, I'm like, man, if I want to keep doing this, I'm going to have to find a way to do it without having all of my money tied up in all these deals. And so that was really what led me down the path of syndication. And It was really like, it was trying to get myself, I was skeptical of a lot of the gurus and the mentors that are out there that are like, I've got 6,000 doors, or I did this 20 years ago and I was super successful. And, like I'm always leery of that, right? Because there's so much bad information out there. Like, how do you differentiate the good from the bad? And so for me, it was like people that I knew, I kind of clung to them. And so I had a couple, friends or people I had met through networking that had sizable portfolios. And I was just, I would do anything to get time with them and have them teach me. And through that, they connected me with some other people that, just helped me learn. And so again, that's how I did it. I think that, if you can find a great mentor that's legit, there's several of them out there now that I've realized over the years that have helped people go from no units to huge successful numbers. It just really is, it's kind of like vetting. I think to me, it's vetting the people that you're paying money to, because it was hard for me to pay somebody $20,000 for mentorship for a year when I really that was a lot of money to me, and that might be, if you, for a normal person, if you saved up 20 grand and you're like, I want to get into real estate investing, like, what's my ROI if I give it all to a guy and I go to a course for a year? Like, it's a hard thing in your brain to understand that spending that $20,000 in that group might lead you to other things, it's just it's a mindset shift that I hadn't had, it took me a while to kind of understand that.
One of the things I really want to hit on, because a lot of people don't know this, but you said that you had a bunch of units like vacate within the first few weeks. Now you need the stop wall.
Yeah. Well, now we factor that all in, right? So now we do a forensic accounting, we do all kinds of stuff to try to combat that. But now it's expected, right? When you're my first deal, it scared me to death. I'm like, what do you mean all these people left? Like, what? And are we going to cash flow up to even pay the mortgage? Like, what am I going to do? And my wife's going to kill me, and we're going to, all the bad things I imagined. But now it's like, it's expected when we go in, depending on the type of property, right? If we're buying a B plus or a B asset, you don't really see that. But if we're buying something C or middle C, and we know that we're going to have to put some work in, we bought a 40 unit last year, and we took it down. He was 96% occupied. We took it down to 8 people living there because we knew going in that that's how that was the plan, though, is that in order to rebrand the whole place and take it from, it was in a great location, but he was running it like a crack house. It was like the location was great. So let's go find the biggest dump on the block and just, we'll win big on that. Right. But the risk is, right, everybody that we had 3 investors on that deal. Everybody has to understand that, we're going to nosedive this thing, but then we're going to take, we're going to pull out at the end, and we're going to save this thing, and it's going to be great. And that's what we did. I think we've had it for 9 months, and we've renovated 38 of the 40 units and moved people around. And, we kept the tenants that were good, that were paying, and got rid of everybody else. And it's just been a great project. But,
so what is the turnaround time? Because renovating 38 out of the 40 units, that's crazy. That's crazy. Yeah. You really did take a nosedive by that one.
I imagine that somewhat depends on the scope of the renovation too.
Yeah, so we're not, so a lot of the stuff, we're doing cabinets, we're doing flooring, we're doing toilets, vanities, we're doing tubs, we're doing surrounds, we're doing windows, we're doing, that kind of stuff. But, we really try not to get into the walls if we don't have to, because when you start getting into the walls, Lord knows what kind of plumbing and crazy things you might find. And so we try to, especially in Ohio, once you get into the walls, you technically have to call the building department, and you can start opening yourselves up to other things with the building code that you have to bring things up to the 2022 code, where if it was built in 1970, as long as you don't touch the walls, you don't have to, rewire the whole thing. But if you go in and you've got the whole building down to the studs, you can believe you're gonna have to bring it up to the new code. So, it's being tactical with it. But we're not, I don't think we're doing anything different than, we're not again, we renovate to the area that we're doing it in. I'm not putting granite countertops in every apartment. There's guys that's all they do, granite and everything. Well, if the people that you're going to rent to, if you're getting $100 rent bump and it makes the deal work for you, but the people you're still going to rent to aren't going to appreciate granite, I don't see the benefit of the cost. If I can put granite in and I know I'm going to get an extra $75 a month or $50 a month in rent, well, sure, then it makes sense to spend the extra money. But it's just understanding your market and the building you're buying and all those kinds of things. But we have a whole team that I mean, and it hasn't gone without growing pains. And we have a team that we use that does a lot of our construction in-house, but we brought it in-house because of all the bad experiences we had with outside contractors or outside construction groups that, that we had to fire in the middle of a project. Like, for instance, we've had one where the guy came in and gave us quotes. We based all of our Capex money based on the quote that he gave us. We had a couple, 2 or 3, but he was the one we picked. And then like 3 months into the deal, we had to fire him. Well, now we bring in, the next contractor, but his pricing is more realistic, and it's 10, I wouldn't say 10,000, it's probably $5,000 more a unit. Well, if you've only budgeted, let's say $500,000, and now the new way, the only way to get this done is the real number is 700,000. What do you do? And how do you navigate that? And so that's really for us is like, that's one of the things I think that is the biggest, can be a big problem that causes people the deals get out of control, is when they don't estimate the Capex properly, and then they get into a deal that maybe they either should have never gotten into, or they didn't have enough reserves. And that's, like I said, then you're either having to do a capital call, and which the investors could say, no, we're not giving you any more money. That is what it is. Then how are you going to figure out, how to still make this a win for you and the people that that trusted you they gave their money to you.
So I kind of want to break things down a little bit, because I know a lot of people don't understand multifamily. So let's kind of, why would somebody invest into granite countertops to get an extra $75? Kind of explain like the amplification of multifamily a little bit.
Yeah. So I guess the first thing I'd say is that a lot of people will do granite because it's the durability of it. Like, it's kind of like, you always want to be considered hardening the unit. So you want to like the hardest surface floors, the highest mill rating of like floors you can find. The granite people will do the cabinets even that we don't buy like the cheap cabinets. We buy, granite or cabinets that are like full plywood, drawers, the box, everything is like built strong, because tenants are going to be there. Just the life is extended. And so you want to do these purchases once. And then before you sell it, you don't want to have to come back in and renovate before you sell. So you want to harden it as best you can on the initial investment of renovations. And so the important thing with any of the renovations that you do in multifamily, and you brought up granite, is if you can get an extra $75 a month in rent, let's say we'll just use a 10 unit for easy numbers, and it's $750 more, by doing that right, $750 more a month. So that's what we'll just say $9,500, somewhere in that range a year. Well, in multifamily, anything above 4 units, you're in commercial real estate. And so the NOI, or the net operating income, divided by the cap rate of that area, can kind of give you a rough idea of what that value of that property will be. And so when we buy a property, we look at what it's valued at now, and then what do we have to do to get the rents $50, $100, $200 more? And then we'll know, like, if we do these things and we get to that, what do we think the value will be at the end? And that's how we evaluate our deals. Like, yeah, the mom and pop owner, he's owned it for 15 years. He's depreciated it out. He's had rents $200 below market, because for him, he was like, I bought it low. He wants to keep the rents low and full. I see that a lot. Well, we want to come in and we want to change out that whole tenant base, and we want to make the money. That's what we're here for. And so that's every decision we make is all based on, is the return on the investment or the return in the rent, can we get the rent bump enough to make the money we're going to spend on that, whether it's granite or the flooring or the cabinets? Like, can we, is the return there? And if it is, we spend the money. If it's not, or it's questionable, then we either do more research, or we may hold off on it.
And I'm also going to guess part of what you're doing is to cut the cost of the turnovers in the process.
Yeah. So the way that we do it now is like, if you harden the unit, or you do it the way a lot of the guys that do these bigger deals, the way they do it is, like now, like once I'm done with the unit and when somebody lives in it, they might live in it for a year, 2 years. Again, it comes down to your management, right? We do quarterly inspections. We catch the people that are like living in filth way before it's like nobody. Like, if you don't walk into your unit for 2 years, then you wonder, you go in and people got roaches and bed bugs and cat urine and dog poop all over the place. Like, that's on you, is in the way I look at it. Like, you need to be inspecting those things regularly to catch it early. But if you do it right, you should be able to send a cleaning lady in there and kind of do, you might have to do some light touch up, some paint, whatever, but you should be able to have somebody move out on Monday and have somebody new in there on Friday. if you do it right. And that's really, like I said, where you start building up steam and you're constantly making money. So your downtime is much less.
Wow. That's really good because man, the turnover, doing turnovers and not keeping an eye on it. Inspection, I never heard that before. Inspections either. I'm new. Like I said, I know a lot of information, but I never bought into multifamily, so it's really interesting hearing that. Turnover, and so you do quarterly inspections. You said quarterly, or
Yeah. So we manage. So in Central Ohio, we manage about 90% of the units that we own, and that is one thing that we do every quarter. We send our manager or somebody from the staff. They go around. They schedule the inspections, and they go through and they walk the unit because that's just part of our. We just tell them it's part of our maintenance plan or whatever. But I mean, it's and a lot of guys will do, like, if you have central heat and air, they will provide the furnace filters to the tenants, but they have to install them. And so they have their maintenance guy go in there every month to install the furnace filter, but they're also like getting eyes on the property. And like I said, catching somebody early that has a, like people love to sneak pets in. Well, if you live in our property, you're paying pet, your non-refundable pet fee, you pay your pet rent every month. And if we catch that, you're getting dinged, I mean, and because again, it all comes back to making the property make more money every year net, and that's where the value comes from. So because the whole gist of like the stuff that we do is we buy it, we renovate it, or we do the value add, and that might just be a different management practice. And then when we refinance it into long-term fixed debt, we want the highest evaluation so we can get everybody their money back out. So it's really important to kind of be dialed in on those things. And if you miss them, you're just leaving money on the table when you refi.
Man, that was a good one.
Makes
I like
sense.
that vent thing, or the filter thing. That is gold right there. Because I'm like, how do you get that in there? But that was a good one right there.
Yeah, and sometimes it's just we have it in our lease too. Like, so like if there's we have some units that are through the wall heating and cooling, like they and so we don't have furnace filters. So just it's cooked into the lease. Like every when they rent from us, they initial next to it that, hey, you're going to get quarterly inspections every 3 months. You can expect that our property manager or somebody from our staff is going to walk through your unit. It takes 5 minutes. But the other thing that you catch is, again, in a property where you're paying for water, like some of our stuff, some of the stuff that we own, like everybody wants to do rubs, if you've ever heard of that, or kind of like bill back utilities. But some properties, you just can't do that. Like, it doesn't make sense. It's the way it's metered or the way the municipality reads the meters or, whatever. So we'll just cook that into the rent. Whatever we got to figure out what that dollar amount is, and we'll cook it into the rent. But where it can kill us is if they have like dripping faucets, or they have tubs that don't shut off all the way, or they have running toilets, and and they don't care, right? They don't ever call you. How are you going to know? And so that's also what our guys are looking for when they go through there is, do I hear a toilet running? Do I, I check underneath the sinks to check for leaks, because some people are, depending on the type of kind of background they come from, they're scared to call and complain about, or not, I shouldn't say complain, they're afraid to call and tell you about a maintenance issue because they're afraid either you're not going to fix it, or you're going to want to kick them out, or like they're just, I don't know what it is. I mean, people are just like, they're scared to report maintenance. Like when I lived in apartments when I was in my 20s, like I'd call and report it right away. But it just depends. I don't know, some people they don't do it, or like I said, their toilet will run and they'll just let it run and run and run and run, and that would drive me crazy. I'd have to call and get it fixed. But those little stopper valves in those toilets, I mean, they can go bad every 6 months. So if you're not watching that, you can flush hundreds of thousands of dollars down the drain every year if you're not paying attention to it,
which can turn
Definitely.
into huge dividends on the end.
Yeah, absolutely.
Mm-hmm. Definitely. Wow. So that term makes me kind of want to jump tracks on the direction. Show me, what is one of your money raises? Are you doing syndications, mix of syndications and funds? Have you generated a fund? And if so, what type of fund?
Yeah, so we do, the majority of the stuff we've done up to this point has been 506Bs. We've not had to really go the 506C route because our network has been pretty good, and we've just gotten everything funded. I talked to some pretty big players on like a national level that are, I mean, they're way bigger than I am, but they're not like REITs or big equity groups, right? Those guys don't even, we're not even in the same pond as those guys. They're not going to talk to you. But the guys are doing some pretty big stuff. I've talked to them and kind of asked them like, well, how do you do it? And they've actually steered away from doing 506Cs because they're handcuffed so much with who they can have in the deal, right? If you're doing a 506C, you're only can have the accredited guys. And what I found is that it really is like, I don't know if you've heard the phrase, like that people will bet on the jockey and not the horse. And so I have found that people really want to know the operator, the sponsor, like that's more important to them than actually what the deal is going to do, right? Because most people will say, how much do you need? And when will I get my money back? Or how long are you going to hold it for? And a lot of the deals we've done have just really like kind of grassroots grown from our networking and people having a great experience. So they tell their friends, and then those guys tell other friends. And or doing podcasts like this where people get to kind of hear, they have a chance to kind of get to know me on a level where it's different than like just going to my website, or like, I spam you with an email, right? You're just going to delete it. So it's just a different way of thinking. And we've been blessed enough to have a great network of people, and we've closed deals, right? And that all that stuff helps when you're trying to build this business. So most of it's been 506Bs, and then we almost created a fund last year. I think this year we're probably going to do it. It's just because we just have deals that come like we'll have nothing, and then all of a sudden we'll have 5 show up that are like great deals, and we're like, well, if we had a fund, we could just buy them, right? It wouldn't be that big of a deal. But like last year we closed a bunch of stuff, and it was like every one was its own syndication. Well, syndications aren't cheap doing the paperwork, and then everyone, if you've got one kind of started, and then you have another one come up, like you have to kind of like, those people aren't able to technically invest in that one. It's a whole like separate thing. And so we found that might just be easier for us is just to set up like a C-class Central Ohio fund, let's say, and then anything that comes to us within Central Ohio that's a C-class property, we can just buy it. And then the money's already sitting there. People are getting a return already from just the portfolio. And it spreads the risk out where you're not just in one deal, you might be actually in 10 deals that are generating the revenue that are paying you your return, or paying in your money back. And so I think it's kind of almost like a little bit safer model, but it's not one that's talked about a ton by syndicators. So I don't know, it's something that we're looking at doing this year.
Yeah, it's definitely a big jump. But you said it though, you get the advantage. You can, instead of jumping from deal to deal to deal, and constantly being in fundraising mode, you can just jump deal to deal to deal to deal. But now at that point, you have to have properties,
right?
So
and that's
you have to be
the
finding
downside,
deals.
right? You start taking people's money and you're guaranteeing them an 8 pref or whatever, like you better find some properties, because otherwise you're losing quickly.
Exactly. The mentors have been working with, it's all about, raising the private money, and then, raising, creating funds. So moving on from the syndications that I've done. So I understand.
Yeah. That's great.
This is a very interesting conversation, because like I said, I'm still learning a lot about a lot of these things. So it's kind of like I'm the beginner on this one. I'm learning. So can you define Capex? What's the definition of Capex? And how does it correlate to like your big picture thing whenever you're acquiring?
So I mean, without getting like super in the weeds with the IRS and how they, how we view it between maintenance and Capex with the tax stuff, the deferments, like the way that we view it is anything when we go into property, anything that we're going to be replacing, like we know going into it, we're going to replace it, right? If you're whether that's flooring, vanities, all the things like I mentioned, like you're even painting, painting by the IRS standpoint is not really a Capex item, but flooring, vanities, cabinets, appliances, all those big ticket items that, like I said, if you got to go in and you got to buy 50 new refrigerators or appliance packages, within the first 6 months, that's a lot of money. That would be considered a Capex thing that you got to plan for, or if you're, we buy our flooring, we buy our LVP by the shipping container load from China. So, I mean, you're going in and we know that we're going to do 50,000 square feet of flooring. We gotta have the money set aside for that, or, when we go in and we buy vanities from, wherever, like I'll use Lowe's, for instance, we go in and buy from Lowe's, we plan with them like well in advance, like, hey, here's the SKUs we're going to buy. Here's here's what we want. And so, again, if you're buying a vanity for, we'll say we buy them in volume. So I'll say $150 for a vanity, but I'm buying 50 of them or 100 of them. It's a lot of money, and so you have to, all of those things have to be kind of accounted for. And that's, like I said, people can really go wrong quickly if they don't account for like if they get in and they don't have the price point on, they're not on point, or they don't factor something in. Like that's really where I see people go go wrong on deals is they're off on that number. And so then you kind of get mid renovation and you're out of money and you're like, oh man, now what am I going to do? Right. Because again, it only makes sense if you hit your metric at the end at the refi and you can get people their money out. Right. If you told somebody, I want you to invest in my syndication, we're buying this deal, I'm going to keep your money for 18 months to 2 years, and then it ends up being 3 years that you held their money, I don't think they're going to probably invest with you the next time. And that's like I said, you got to be pretty precision with some of the stuff that you're doing.
Wow. Okay. That was good definition. Oh man, that was good. That was a good one. Okay. So next question I have is, we kind of talked before we came on, is that you're now acquiring 160 acres that you're going to cut out your multifamily part of it and sell the rest off to investors and kind of build the multifamily around that. Let's kind of talk about that deal, because that's interesting.
Yeah. So one of our partners in the stream group, there's 3 of us, and the third guy, Tim Watke, he's involved like when he wants to be. He's a big player out in Utah and doing his own thing, and he's involved in a lot of our deals, but he's like, he's kind of like our big sledgehammer when we find something big, or we find something that like just seems to be like a great deal, or we made a couple offers on some major projects last year, and so he's involved in those. But if it's like a 40 unit, he's like, hey, I don't necessarily want to be involved in that or whatever. So he comes in for the big stuff. That's what he likes. And so this was again a broker that I have a great relationship with. My kids go to school with his, like I've known him for several years. He had been working with some older gentlemen that had this property out here in Central Ohio that's it's like 150 acres. They had been working on the zoning and getting the entitlements. Well, they hadn't started on the entitlements, but working on the zoning for this property to be a single family development, multifamily, and assisted living. And when he was telling me about this, like last summer, I'm like, don't you say nothing to anybody else. Like, I want that property, because I just knew, I'm like, this is great. It's in my backyard. It's in a great location. It's just something that we could do. And we've been kind of toying with the thought of doing development. Like, I don't want to get into being a single family developer, but because this has different chunks and pieces to it, like it was really something that was great for us, because there's like 3 capital events that can happen within this one deal. So if you're an investor and you get in, you get in early, like let's say in the first 6 months, you're like, yeah, I want to invest in this. When we sell off the land to the home and the home builder, there's a capital event there. So you could get your money back and you could go on and do your own thing. Or you could say, hey, I put in this money, I just made X amount of dollars on my equity piece, I want to roll it into the next part. And then at that capital event, you can either take your money out or you can roll it into the third part. And for us, the goal is to own the multifamily chunk of land. It's 17 acres. I think they're allowing like 180 units out that way. But what's great about it is in the process of kind of working in this deal out and keeping up with the broker and just kind of keeping on, being like kind of at his fingertips, like every time I talk to him, I bring up this land, like, hey man, what's the deal with that? How's it going? Like, what's it look like? Are they ready to sell yet? What's the story? You better not be talking to anybody else. And then Intel comes out and says, hey, we're going to drop this $20 billion investment in Licking County, Ohio, which is the neighboring county to Columbus, which is the county I live in. We're going to build this. This is like the largest plant that they've built in like the last 40 years. It's this huge driver right now of like, Facebook's come out here, Amazon's come out here, and then these guys are showing up and they're doing this humongous investment in this area. And they're talking 10,000 jobs it's going to bring, and just offshoot businesses and things that they like, stuff that they're going to bring to the area to supply them with what they need to run their plants. And it's like 7,000 construction jobs we're talking about. Huge impact on just the state as a whole. But it's literally like out my front door and then out my back door is this land. So it's really gotten to be exciting for us, where I think that the development piece is going to be, it could, again, it's going to be a life-changing deal. If it goes right and everything goes as we think it will, like I said, it's going to be something that's going to take us to a whole nother level.
I think what I like about larger transactions is that any single one deal could be a life-changing deal, because even your 50 unit changed the trajectory of your life.
Yeah, absolutely. 100%. Yep. And that's the thing too, is that, multifamily is great because, like, you kind of talked about carving up the deal. Everybody kind of has a different role. Like, you could be like, let's say you're a capital raiser, or you're, you're really good at finding deals. You could go out and find 5 different deals and do them with 5 different groups. and get enough equity between those 5 deals that just change your life. You know, I mean, it's, and you're talking 5 deals, right? I always tell people, Tim Bratz always says, I think he was the one that originally coined it, but you know, he always says, you know, like how you can either own like a 100% of a grape or you can own a chunk of a watermelon. And I just, the first time I heard that, I'm like, what a great analogy, because that's it, right? You can own your 10 or 15 single family homes and like you own 100% of it, but you're also stuck really having to be the guy that manages it, does all the renovations to it, that does all the maintenance stuff, because you're not big enough to really employ people to do it. And you're trying to live off the cash flow, having it impact your life. So it's like you're skimping on, you know, you're not going out and buying flooring by the container load. You know what I mean? Like that's where, for me, it was like, that was the jump, right? And I see a lot of guys kind of struggle with that, where like they don't want to give up necessarily the control, or they've been used to owning 100% of the deals that they've done. And it's like it's, I don't know, it's something in their mind where they just can't seem to like let go of the fact that like, I'm not going to own all of this. Or, you know, again, you do a $5 million deal and you own 20% of it. Well, that, I mean, that chunk of equity that you own is like, how many single family homes do you have to flip, or do you have to own rental wise to earn what that chunk is worth? I mean, you know, and it just depends.
Mindset is 100%.
Yeah. And it just, you know, again, whatever your end goal is, you know, I had my end goal in mind, and I've just, you know, been laser focused on it.
Definitely sounds like some tremendous success there. I know one question, I'm going to cut Daniel's legs out from underneath him on this one. He loves to ask, what's your favorite book right now? You know, what book got you started, like really lit that fire? And then like, what's your current recommended book to anybody?
Yeah. So I would say, obviously, if people, I feel like every investor's always heard of Rich Dad Poor Dad, but you know, I always bring it up because, you know, it just, if you've never been exposed to real estate investing, or even the difference between asset and liability, like that's such a great book that's changed so many people's lives and really kind of flipped the switch, right? I mean, I always like to talk about the movie The Matrix, where, you know, Neo's in there and he gets the option of the pills, man. And once for me, I read that book and I was like, well, I'm screwed now, you know, like I've completely unplugged here. Like this is no fun anymore, this regular life. Like I got to go out and do all this stuff to make my life better and obtain that. So I think that was a great book for me. And then another one that was super impactful that I've read it several times, but I like sharing it anyways, is because it's a book by Dan Sullivan called Who Not How. If people have never read it, like, again, it's like you and I have read it and we're like, yeah, we know it, but like there's so many people out there that have never heard of it. And for me, being a guy with a blue collar background who was always, you know, being in the fire service, we fix everything. We always have the solution. You know, if my even like, I mean, I'll tell you, for instance, like for me, I stopped cutting my lawn last summer, and that was like the hardest thing for me, because I'm like, I'm so busy during the week. Then on the weekends, I finally told my wife, I'm like, I don't want to cut the grass anymore. Like I want to go, like, let's go to the pool, or let's go to the lake, or let's go do something with the kids. Like I want to spend my free time doing the fun stuff and not slaving away out in my front yard. And like, and it was like, I lost sleep over it, because I'm like, I felt like my dad would roll over in his grave, like the fact that I'm not cutting my own grass. Like, what kind of man are you? You know, but it's just, it's talked about in that book where, you know, if you really want to scale and you want to grow, like you've got to find the things that you're good at, and then anything that you're not good at, get it off your plate and give it to other people. Find the who, like if you know, like I said, find the who to whatever the how is. So, you know, like again, you need to create a website. Can you sit down and spend 3 months trying to figure out how to do it? 100%. But you could just call somebody that does web design and pay them the money they're asking for to do it, and it's done in 2 days, probably better than you would have ever been able to do it. Or even like podcasting, for instance. I know a lot of guys that, you know, when they got started, they wanted to edit and, you know, kind of clean up their own stuff. And it's like, when all of a sudden for them, when they started scaling, they're like, man, I just, you know, or like some of them do daily podcasts, you know, it's, you have to just record it, do the fun stuff, and then just send it off to a guy that's what he does. And it'll look better and cleaner a lot of times than what you and I would even do.
Yeah, anything you can do to buy your time back is a win.
Yeah.
I laugh at you with the cut the grass thing, because like I had a lawnmower, and then when I moved, I'm like, I'm not cutting the grass anymore. I don't even care anymore. Like I have better things to do than cut grass.
That's what I mean. Like for me, the guy comes over, cuts my grass, he charged me $30 to do it. I'm like, it takes me an hour and like 20 minutes to do it with my mower. And he comes over this zero turn, and I'm like, dude, I'm for $30, I can free up an hour and a half of my time. Like, what can I do in that hour and a half that's going to generate more revenue for me? Or like I said, it could be nothing.
And he does it in 20 minutes.
Guys, you know. But
And he
it's
does it in 20 minutes, plus he edges, trims, weed
everything,
whacks,
right? And it looks
all of
better
the
than mine
above.
because he puts lines in
Yeah.
it. Like, I can't do that.
Yeah.
So I like this question too, is what is a quote that's yours or somebody else's that you resonate with?
I'll keep it simple. Warren Buffett, he says never, you know, I don't know the exact of it, but it's like the number one rule in investing is don't lose money. So
There you go.
there's a lot of times where there might be things that like I want to do or my partner want to do. And like, we always circle back to that. Like, remember, never lose money. Like, that's the number one thing, right? Because sometimes it's hard, you know, like you get excited about things or you want to like, oh, like, again, it's shiny object syndrome. Like entrepreneurs, like, you know, guys that are, you kind of get like into real estate and you're like, you're always kind of chasing that next deal or that next high of the, you know, the return you got or the, you know, whatever it may be. And it's like, there's so many things that, you know, I've seen people try to make money and like maybe they were super good in multifamily and they thought I'm going to shoot off and do some storage units, or, you know, like for me, it's hard because I'll see these guys wholesaling contracts for houses that are in my area. And I'm like, man, that would be a great flip. Like I could do that. I would just let me buy it. And then I got my guys go over there, they can fix it up, but I could flip it. And I'm like, I have to stop myself. I'm like, no, that's not the focus here, you know, because it only takes one deal to, you know, like I buy it and then it goes bad and now it's distracting me and it's sucking up all my time and resources. And then all these other things kind of go by the wayside. And that's, at least for me, I always have to remind myself to not, you know, not get into the weeds on these other things. And I just, like I said, laser focus on multifamily, growing our business, meeting new investors, you know, just get in the room with great people to work with. And, you know, that's what I got to stay focused on all the time.
So where are you doing? Let's start off with like how many units do you have under management? What deals are you working on currently, and where can people send you deals?
So we are, like I said, in Central Ohio, we have about 600 doors, a little bit over that, I think now, and we manage probably 90% of that. I've got some stuff that I like that I've given off to a third-party manager that I'm really good friends with, and I know and like and trust him, and he's 100% like in line with my vision, and so he runs it the way that I want it to be ran, and it's been phenomenal. So we let him run that stuff, but the rest of it's all ran in-house by our management team. And then we have some equity holdings in multiple different states. And that's the whole stuff that basically like it's operators that we, you know, somebody within our team knew, and we either, you know, signed on the debt or we invested with them, or we, you know, we got on the general partnership side because maybe it was their first deal, or, you know, whatever the case may be, the deal was bigger than they could do. So they had one of us come in on it. You know, and so we kind of have that going on, but most of the stuff that we really try to take down is here in Central Ohio that we, you know, that I don't go outside of my backyard, basically. Like I just haven't had to, right? We live in a great area, great market. Columbus is super hot. The surrounding areas are doing nothing but getting better and thriving because Columbus is doing so well. The housing market or the housing shortage in Central Ohio was crazy. So, I mean, all these areas that, you know, 2, 3, 4 years ago, maybe nobody was buying in, you find like people are being pushed out. That COVID has really helped too, because people are working from home. They're able to live farther away from the metro area. They can make great metro area money, but live an hour away because they don't have to travel to the office every day. So we're seeing a lot of cool things. And I think kind of like for me, it was like, you know, the lake or the pond that I'm in, I would rather go super deep in that than go like super wide. You know, there's some people you have to, right? If you live in New York City, you have no option but to go outside of your area to buy. But for me, I don't have to do that, right? So we're doing great here, and that's just what we like. And, you know, really like our kind of sphere of influence is an hour from Columbus, so we could go to Cleveland. It's a little bit farther away, but Dayton, Cincinnati, I've looked at, you know, but really anything in between. And then if there's other operators that like, you know, they want that comfort or that person to sign on it of the deal with them to kind of help get them through their first one or second one or whatever, like that's really what we specialize in.
That's awesome, man. That is awesome. So how can people send you deals? How can people send you deals?
So they can go on our website. It's www.thestreamgroups, it's plural.com. And then on there's like a kind of like a questionnaire thing where if you're an investor or you're just somebody that wants to get in contact with me, that you can fill it out. It comes to my email. And then usually I'll like I said, I'll follow up usually within 24 hours. And then we'll set up a time to chat or whatnot. And you know, that's probably the best way. I'm on Facebook, just Seth Teagle. You can look me up on there, LinkedIn or Instagram. You know, we're on any of those kinds of platforms, and so people message me all the time on that stuff. And and we start conversations that way, and then kind of go from there.
Well, that's great, man. I was about to ask you, where can people find you? Be like, oh, we're on Facebook. So led right into it. We're good. Covered it. Well, we appreciate your time, Seth. I think it was a great conversation. We covered a lot. I appreciate Frank for helping me out here. And thanks for coming on. I hope we maybe we'll send you a deal down the line.
Yeah, absolutely, guys. I appreciate it. Thank you very much.
All right. You have a great day. Thanks for coming.
Thanks.
Have a great week.
Yep, you too. Thanks.